Hi, welcome to the Hobart Weekly, a series created for our clients to bring you relevant financial planning insights, timely updates, and helpful perspectives each week. My name is Andrew Greer. I'm the Senior Wealth Advisor at Hobart Wealth, and today I want to walk through something that can have a huge impact on your long-term results. The biggest mistakes investors make and how to avoid them, because let's face it, the reality is investment success is often less about picking the perfect portfolio and more about avoiding the wrong behaviors along the way. So let's jump in. Mistake number one, we're all guilty of this at some point, and that is trying to time the market. This is probably the most common and most costly mistake. Investors try to jump in when things feel safe, if you will, and get out when things feel uncertain. The problem, by the time things feel safe, markets have already gone up. And when things feel scary, a lot of the damage has already been done. So missing just a handful of the market's best days can significantly reduce long-term results. How do we avoid it? Sometimes easier said than done, but stay invested. Follow a disciplined plan and accept that short-term volatility is part of long-term growth and success. Mistake number two, letting emotions drive decisions. Fear and greed are powerful forces. Fear can cause you to sell at the worst possible time. Greed can push you to take on more risk than you should. Neither tends to end well. How do we avoid it? Have a plan before emotions show up. When markets get volatile, fall back on your strategy, not your feelings and emotions. Mistake number three, lack of diversification. It's a bit of a cheesy cliche word, but it's very important. Putting too much money into one stock, one sector, maybe even one idea can expose you to unnecessary risk. Even great companies and strong sectors go through downturns. How to avoid it? Build a diversified portfolio across different asset classes, sectors, and geographies. Diversification doesn't eliminate risk, but it sure does help manage it. Mistake number four, focusing too much on short-term performance. It's easy to get caught up in what the market did this month or even this year, but investing is a long-term process. Constantly reacting to short-term performance often leads to poor decisions. How do we avoid it? Zoom out. Focus on your long-term goals and progress over years, not weeks or months. And finally, mistake number five, not having a clear plan. This might be the biggest one. Without a clear strategy, it's easy to drift, react, and make inconsistent decisions. And inconsistency is what derails progress. How do we avoid it? Have a defined investment plan that aligns with your goals, timeline, and risk tolerance, and stick with it. So to summarize, the investors who tend to be the most successful over time aren't the ones chasing the latest trend. They're the ones who stay disciplined, stay diversified, and stay focused on the long term. Avoiding these common mistakes can often matter more than trying to find the perfect investment. So thank you all for spending a few minutes with us at Hobart Weekly. We hope this was helpful, and we look forward to continuing to share insights that support your financial life. See you next week.